Hello, everyone. On today's show, we have a pretty timely topic for you, Bitcoin. This episode is really just jam-packed with some magnificent information for anyone invested in Bitcoin, considering an investment in Bitcoin, or simply those that want to learn more. In the episode, we explain what Bitcoin is. We discuss how investors should think about Bitcoin. Is it a currency, a commodity, a collectible, or something completely different? We get into why the U.S. government currently owns the largest Bitcoin wallet. We talk about some Bitcoin lingo you may have heard thrown around, like what is the halving and why is the halving important for investors? We go through the different Bitcoin funds that are now available and what to look for when choosing a fund to gain exposure. We also examine the dramatic price swings you should expect as a Bitcoin investor and how those price swings are a factor of the way the Bitcoin industry works. Listen, this asset class can really move dramatically both on the upside and the downside to the extent that most investors are probably not used to. And let me tell you, if you don't know what you're getting yourself into, you're potentially setting yourself up for failure. This is really not an asset class you want to go blindly into. I know I'm dragging on here, but a few administrative tasks before I send you off. Did you know YouTube and Spotify have linked timestamps that allow you to jump around to specific topics within the show? That's right. All you have to do is expand the description box and it's all right there for you. Lastly, I don't know about you, but I rarely feel like I have time to sit through a whole hour-long show. Personally, I like to listen to these at 1.2 times speed to make them a little shorter. All the major platforms allow you to do this. On YouTube, you just click the settings wheel on the bottom right of the video, go to playback settings, and rev that up to 1.2 times speed. If you're listening to one of the podcast versions, most platforms will show a number 1 with an X next to it once you are playing the show. Click that number 1 and change that to 1.2 speed, and you'll be all set. All right, without further ado, here's the show. Adam, you were on vacation recently, right? How was that?
It's good. I wouldn't consider it vacation so much as a trip, but
what? Does that mean the kids came?
The kids were there. Yeah, vacation's like my wife and I go away without the kids. But
okay,
this was not. I guess it was a lot of fun. It was not relaxing, right? So vacations can be relaxing.
Yeah. Where did you go?
We were in the Bahamas.
Bahamas. Okay.
Short flight, 3 hours. Resorts have the water parks, so it's easy for the kids. Food is good. Kids under 5 eat free.
Was it all inclusive?
No.
Okay.
I mean, unless you count kids under 5 eating free as all inclusive.
All inclusive for the kids.
I can tell you that adults were definitely not free. And that's only some of the restaurants at this place. So,
okay.
No, the Maxine she's about to turn 4 in a couple weeks, and the coconut smoothies, aka a pina colada version, of course. $15 at the pool. She takes what? Like, she drinks half of it. But then she's like, okay, I want to go swim. And it's like, well, all right.
And then it melts. Yeah. Wow. Yeah. I'm a fan of all inclusives. I think, in my opinion, there's 2 different types of vacations. There's the adventure, the exploring a new location. There's the restaurants, the sightseeing. That you obviously can't do really all inclusive. Generally involves some planning, some level of stress. But then there's the all inclusive where I feel like you don't have to worry about the price. Everything's kind of mapped out for you. You stay in a general location.
The food's typically not as good at an all inclusive though.
Definitely not as good. Definitely not as good.
But there's a convenience factor there.
Sure.
It's just like you don't have to carry your wallet around or anything like that.
You're talking to the guy who eats to survive though. So if given the same option, I will eat the same 3 things every week. Actually, I used to before I met my fiance.
Have you been to France? You just get a croissant everywhere.
We're actually that was actually in the air for our honeymoon, but no, I've not been to France yet. Okay. Yeah. Been some other good other places though.
Yeah, definitely not eating just to survive.
Yeah. Have you been on a cruise?
No. Never been on a cruise.
I like cruises too, but I also a big water guy. Love water, so I like the convenience. Now, don't get me wrong. Sometimes I like to explore Egypt or Africa or something like that. But, the casual cruise every now and then where everything's taken care of for you, you could sit out and just gaze onto the endless ocean with your Miami Vice. That's not too bad every once in a while.
Do you feel trapped, though? I mean, I don't know. I've never been on a cruise, so maybe I'd love it. But
They're big. They're big.
The rooms are also smaller, so I know that going with children would be
right.
That would not add to the relaxation aspect of my trip.
I actually hear the Disney cruise is great for kids. You basically just hand them off to the staff and you're on.
All right.
So,
maybe I got to look into that.
Maybe. Let me know. I'll join you. So,
are you sure? Are you sure about that?
Should we cue the music? Let's get this going.
Let's get started.
All right. So today you're going to speak to us about a bit of a decisive topic, right? Let's see here.
We've got no guest. We've got no guest this episode. I wonder if people were watching the intro kind of waiting for someone to join us. But I guess I'm the de facto guest.
You were the de facto guest. But we have a big topic here, Bitcoin. There's been some ETFs that have come out.
Look at this. Look at this image here.
I know.
Great.
I know. Who do we have here? So Warren Buffett, right? One of the probably most renowned, one of them at least. He's got to be in the running, right? Top 5, top 10, maybe top 3.
Top 3.
Investors
top
of our time.
Top.
He's not much of a Bitcoin guy. Jamie Dimon, probably one of the top, if not the top bankers.
Maybe not investor, but like CEO.
Yeah, CEO, banker.
Businessman.
I'm pretty sure he told the government that he would make it illegal if he was in that position too, right? I'm pretty sure he was at some sort of Bitcoin, right?
I believe.
And then we have Mark Cuban, who I think he's a big flip-flopper, right?
He has waffled, but I think since about 2020 or 21, he's been pretty pro digital assets.
Yeah, I can't keep up with him. I think at one point he was saying everyone should have 10% of their money in Bitcoin. Then he was saying he'd rather own bananas than Bitcoin. Now I guess he's
then he got hacked. He got hacked for like $1 million a couple of months ago. But he's still pro digital assets. There you go.
Assets. All right. And then Paul Tudor Jones, who I think he
made a splash a couple of years ago.
Yeah.
During that run up, being a big advocate for digital assets. Yeah.
Yeah. I think he talks about owning a basket, like a preservation of wealth basket of equally weighted Bitcoin, gold, other commodities, and cash, which
that makes sense. What's that? That's like a portion of his account.
Right. Or at least at one time. I can't. It's been a while since I've talked to Mr. Jones.
I don't think cash and Bitcoin are very similar, but if you want to put those in the same bucket, that's all the power to you.
All the power to you. Which I guess, is one of the things we're going to talk about, right? How do you think about Bitcoin? What's going on there? So why don't you take us through your slide deck you've prepared?
Well, I'll just say, first of all, look at this image. This is great. What is this? Is this Nick behind the scenes doing some AI magic?
Warren's looking buff. They're all looking buff.
They're all looking pretty jacked. Cuban's got the tongue out. Is that like a Michael Jordan throwback? Paul Tudor Jones has the microphone, so maybe he's like playing the Dana White character. But no, we're gonna get into it. This should be a good podcast. We'll cover everything from, for those that don't know or haven't heard of it, what is Bitcoin? How does it work? We'll dive into kind of some comparisons. We're going to compare it to gold and other collectibles, which should be nice if we want to look at it as like a commodity, kind of seeing what pluses and minuses Bitcoin and digital assets have. And then I forgot to turn on my little light here. Pardon me. But
there you go. Now it looks like you went tanning.
There you go.
Looks like you actually went on vacation.
Right. And then we're going to get into a little bit about blockchain, because that is the basis here for Bitcoin. Without understanding blockchain technology, which has many applications, you can't really understand Bitcoin, which gets us into the mining aspect and how the network functions. And from there, we'll dive into supply, demand, ebbs and flows, the market ups and downs that we are commonly aware of, 20,000 to 3,000 to 5,000 to 60,000 to 18,000. And now we're back at 50,000. So it should be good. And then, of course, ETFs just came out, right? We had
which is huge. Big news.
Yeah.
Big news for the Bitcoin market.
10 of them. I think 10 of them all came out and were approved on the same day. It's pretty historic landslide moment. So we'll get into that and what that means for investors. So looking forward to it.
Yeah.
Bitcoin really at its core, I think we should kind of cover what it is. And I'm going to read off a definition here that I found online, but it says Bitcoin is a digital currency. Okay. Chalk that one up. Currency that uses blockchain technology to support transactions between users on a decentralized network. Okay. So the definition right there calls it currency. I'm hesitant to go that far. I mean, I know we're kind of putting me as the the guru here on this topic, but I'm curious what your thoughts are on Bitcoin as currency.
So I'd say I have trouble looking at it as a currency because when I think of currencies, of course, I think of the US dollar, which actually may be an unfair viewpoint because there's a lot of currencies out there that are not as stable or, divisible and well maintained, so to speak, as the U.S. dollar that has become the world currency. But in comparison to the U.S. dollar, as unfair as it may be, I would say Bitcoin is definitely not there. When I go to the store with my wallet with anticipating making a big purchase or even a small purchase, I anticipate that the value of my currency that I'm going to use to pay for whatever I'm buying is going to be relatively, where it was when I left the door.
Right. Or like remembering a password to use your money. That's kind of ridiculous, right?
Right. Well, these days, your phone, you just look at your phone, right? It opens up.
I guess so. Yeah, you just hold it in front of your face. I'm not. Look, you can transact in Bitcoin, but I'm not ready to call it a currency yet. I understand that's the ultimate goal for Bitcoin truthers out there and really hardcore believers, but I probably wouldn't go that far yet. So I think the fact that it is decentralized is a big key to this. The fact that, and we'll get into this, we know every single wallet that's out there and how much Bitcoin is holding and how much it's holding. We don't know who the wallets belong to, but you can see the breakdown of the earnings, which is quite cool. So let's jump into some of these line items here. I think it's interesting to compare it.
What are we looking at here?
A lot of people refer to Bitcoin as the new digital gold, but we also wanted to look at, is it just a fad and a collectible like Pokemon cards, or we're comparing it here to a Mickey Mantle baseball card, but which sold, I believe it was 2 summers ago or 3 summers ago, for one of them sold for $7 million. So those cards have held its value over time. Gold holds its value over time, but we took a number of different qualities, attributes of all these things and wanted to line them up and see where Bitcoin stacks up among some commonly compared asset classes. So we look at durable, divisible, down the line here on the left, and then looking across at the 3 assets and seeing which checks the boxes here. So I think, right off the bat, you can see that Bitcoin kind of checks a lot of boxes. It doesn't have tangible value. That's a very common hurdle for people to get over in understanding Bitcoin, that you can't hold it, you can't touch it, you can't withdraw it and feel it in your hands like cold hard cash or gold or a baseball card. And then it hasn't really been around that long, right? I think the idea was just created in 2009, and then the first Bitcoin wasn't actually mined, which we'll get into the mining process later, but it wasn't actually mined until 2010. So it hasn't been around even 15 years yet. Mickey Mantle, obviously, and his rookie card has been around longer than that. But when we talk about track record in this case, towards the bottom here on this chart, I think we're looking at gold as having a track record of millennia. So I don't know, anything here you want to dive into? I look at this, and we can go down them one by one if you want, but I look at this and I see Bitcoin's got a lot of arrows in his quiver compared to gold and compared to other types of collectibles.
Right. Yeah, no, I think, what are we looking at here? So durable, when I think durable, can it protect your purchasing power over the long term, right? We have all three boxes, gold, Bitcoin, Mickey Mantle card, have been able to check off that box, right?
Adjust for inflation. Positive. Yep. Keep your purchasing power worth over time. I would say Bitcoin's probably the most volatile of the bunch here. Maybe baseball cards a second, and then gold a third if you had to rank them.
Right. Well, I think baseball cards they could be equally as volatile if they were actually priced on a day-to-day basis.
That's right. I don't know how there's no pricing mechanism daily for a Mickey Mantle rookie card, but
right.
That's a good point.
Right. And then we have divisible.
Yeah. So it's kind of hard to divide a Mickey Mantle rookie card or a bar of gold unless you go to a jeweler, right? But Bitcoin's divisible into, I don't know if you know this, but you can divide a Bitcoin into 100 million parts. A dollar can only be divided into pennies, which is 100th, right? I guess you can buy stocks for thousandths of a penny per share, which is kind of interesting.
Especially with when you could split the shares up.
Fractional
shares.
Yep. But Bitcoin's got 100 million. They're called Satoshis, named after the creator, or Sats for short. 100 million Sats. So you can buy for less than a penny. You can buy one Satoshi worth of Bitcoin. Actually, it's interesting. So very divisible. What do we have here? Fungible?
Yeah, they're all very fungible, right?
Yeah,
that makes sense.
Trade them for other Bitcoin, interchange them.
The Mickey Mantle card, I think
if there's another rookie card, you
a mid condition, an equally right.
Yeah, maybe that's a half plus for for the fungibility of the baseball card there. But gold is gold, right? As long as it's verified. Bitcoin is Bitcoin. Portable, this is definitely something in the camp of Bitcoin versus gold. It's it's over the internet, right? It's not something you hold. Gold is heavy. It's not very portable at all, right? If I wanted to transfer or take $1 billion worth of Bitcoin and $1 billion worth of gold with me on a plane, it's very easy to do that with Bitcoin. It's very hard to do that with gold.
And that's an important qualification. We're not talking about a gold necklace. We're talking about, can I move my life savings from here to here easily, right?
Yeah.
For gold, you'd have to, rent trucks, use some heavy machinery to move $1 million.
Well, you said necklace, right? So that's tangible value at the bottom. So gold actually has tangible value. I would argue that the Mantle card does not have tangible value. You can hold it and look at it, but it's not like a painting or artwork that hangs on your wall and gives you some sort of enjoyment. Bitcoin, zero tangible value, obviously.
Right.
They have actually, like replica pretend coins that you can buy, but those are fake. They're not actual value holding mechanisms.
Right. And that's actually, what I question about Bitcoin is tangible value. What's the it factor for Bitcoin that decades from now, people are going to want to keep owning it at a higher price? Gold clearly has a tangible use, right? We talked about it. There's whether it's a necklace or, they use it in windows of buildings to help control the temperature, things like that. The Mickey Mantle card, at least you could take it out, show it off, look at it, right? What's the it factor for Bitcoin? And maybe that's where the massive return potential comes in, taking a big risk.
Ultimately, it's the scarcity. I think if you ask people, it's the fact that there's only ever going to be 21 million Bitcoin. And it was the first of its kind, first digital asset of its kind. So if you want to talk about first mover advantage there, a common argument is, well, why don't they just create more Bitcoin or a different version that has more? It's just, it's not Bitcoin, right? And Bitcoin does have a value now in and of itself, and because of that scarcity. So gold is scarce as well, although the inflation rate of new Bitcoin coming into the market is about to be lower than that of gold coming up here very soon. So it's going to have and be more scarce than gold, and will continue to be so until all of the Bitcoin are mined and 21 million are out in circulation at this point. Scarcity, obviously, with the Mantle rookie cards, they're not printing more of those,
right?
At least that aren't of any value. So,
right.
I think that's where there's no tangible value, but it does have, you have rights to your wallet and your line item of Bitcoin and your ownership of Bitcoin. It's your own private password that secures it, and it's not something you can physically hold in your hand, but it does take up space on the internet, and everyone can see it and value it accordingly as yours. So in the age of the internet is actual physical tangibility. Like, everyone's walking around with these. Have you seen anyone walking around with the Apple?
I have not actually in person seen one yet, but I've definitely seen
a couple
videos.
People walking through airports and stuff like that. And like, I don't know. I feel like we're just going to be blobs on a couch one day, but hey, I'm going to have, a Bitcoin in my digital wallet that maybe once we are all in the virtual world, you'll be able to see it and hold it virtually.
Right.
It's a little, look, part of talking about Bitcoin, I do think it requires a little bit of, like, there's a level of philosophical conversation and debate that comes with it. So bear with us if you want to get nerd out a little bit. But I think the value of a Bitcoin comes from its scarcity more so.
Yeah.
And we'll get into this too, but it's also a lot easier to transfer and transact. The portability, the fungibility, the divisibility. It is more so than gold and even currency in some cases, right? Like, it takes a couple hours to wire money across the world to another bank, and what's that cost you? $15, $25 for a wire fee, right? Same day transfer, a couple hours. You can transfer Bitcoin in 10 minutes, 5 to 10 minutes. One of the largest transfers was nearly $1 billion, and it cost $2.69 in fees to the network. The average fee is typically around $1 to $5 per transfer. You can do an ACH for free, but that's next day. So it's not 10 minutes. So there's a lot of reasons why Bitcoin could become, used more as a currency in the future if the volatility declines over time.
Yeah, and maybe that's where the potential return comes in, right? If over the course of time there becomes a very strong use case that develops that more people are on board with, right? If you could walk up into the street and say, hey, you have Bitcoin, what do you think of it? And everybody on the street goes, yeah, I love it. And because of this use case, right? Then if you buy Bitcoin now, to that point in time, you probably have done very well in that coin. Where there's risk, there's high potential return. So that could be part of the investment thesis right there. Yeah,
I think part of it is in the blockchain aspect of this, and maybe this is a good segue, but I talked about the scarcity and how new Bitcoins are coming online. New Bitcoins are mined, and mining is the process of verifying transactions on the blockchain. So if you trade Bitcoin or buy Bitcoin, that gets logged in a transaction and added to the blockchain. And those transactions are verified by miners, and miners get rewarded in Bitcoin. So there's this mechanism of creating value for maintaining the sanctity and the exactness of this digital ledger of who owns what and who's transacting with who. So I think that's important too when you consider, like, is it secure? Is it safe? Can you hack it? I think it's important to understand how the mining works and how blockchain really functions in order to say, okay, this does kind of hold some truth and some value because there's people that are incentivized to keep its security and keep it true. if that makes sense.
And that's why we're giving Bitcoin on the verifiable line here. That's why we're giving Bitcoin a plus, and we're giving the Mickey Mantle card a minus, and the gold a minus. Not because gold can be verified, the Mickey Mantle card can be verified, but it's a very cumbersome process, right? Bitcoin can almost instantaneously be verified within a couple minutes.
Yep. And the wallets that hold certain Bitcoin as well. Yeah, exactly. Should we dive into blockchain? What do we have next? Maybe a little fun facts about Bitcoin, I guess first. May 22nd, 2010, it was one of the first currency transactions, if you will. Someone exchanged 10,000 Bitcoin for two medium pizzas or large pizzas. And those would be worth about $500 million today, based on a price of $50,000 per Bitcoin.
$250 million a pizza. Well, I see one has toppings, so maybe that one costs a little more.
But yeah, maybe 6,000 and 4,000 a piece. I don't know. There you go. Maybe the cheese is a little less, but I don't know. What do you think those kids are up to now? You think they're happy with their dad still?
Hopefully their college is paid for.
Right. Hopefully he didn't spend all 10,000 that he owned on the pizza and kept some behind.
Yeah. I think he came out recently and said that he was still happy he did it. I think he acknowledged a lot. Yeah, something like that. Then there was a college kid, right?
But he's lying, right? He's not actually there's probably some part of him that, unless he went out and bought more. But
no one wants to be in that position, right? No one wants to say, "Oh yeah, I could have made X amount." No one looks at that. That's just not.
It was also it was $15 at the time. Like maybe he just went out and bought 20,000 for $30. I don't know. Who knows?
I don't know what delayed gratification. I guess it's a lesson in delayed gratification.
I guess so.
But I think there was a couple hot. Right in the very beginning, there was that college kid. Right, he had the Hi Mom sent Bitcoin on. I think it was one of the college football game shows.
Yeah,
and he made like $25,000. Yeah. I actually wonder how much money is trapped in locked wallets these days.
There was. I remember in 2020, 19, 20, in that run up to 20,000, I heard a story about a guy who, I guess he had like a USB key or some wallet that was locked away in the attic, and they did some spring cleaning. The wife was doing some spring cleaning, and he went through it and thought nothing of it. And I guess the wife took it to the dump. This was in England, I believe. And maybe it was when it was worth a lot less, but he realized when it was worth a lot more, all of a sudden, that he couldn't find his key, his wallet full of Bitcoin. And he went back to the dump, and I guess they had found some toxic waste in the recycling plant or in the dump. And they had the military come out and basically block it off. No one could go in or out. And he was pleading with the British military to let him go. And he knew exactly where he dropped the box and where he could go and find it. And it was worth $20 million or something like that at the time. And they just wouldn't let him into the dump because of this toxic waste spill that was there. So that's crazy. Tons. I'm sure there's tons of, there's estimates out there. I think it's 6 of the 21 million Bitcoin are presumed to be lost and not even, able to be moved or accessed ever again. So that scarcity is probably just going to increase with time.
Yeah, that's actually crazy. I could definitely see that happening in my household. Megan is the queen of cleaning up, and I'm walking around. Hey, have you seen my shoes? And she's like, no. You mean the dirty ones that needed to go in the garbage?
Right.
That would definitely be something that would happen to me. Secure your Bitcoin.
My dog ate my Bitcoin.
Yeah.
What do we have coming up here? Oh, this is great. So this is just showing the distribution. Like we said, the blockchain is public information, so you can read through it. And this is an analytics breakdown of who owns what Bitcoin. So on the leftmost column, it's the balance. It's ranges. So between 0 and 0.00001 Bitcoin in a wallet address. There's 8.4% of the total addresses that hold, basically 100. What is that? 100 thousandth of a Bitcoin. Yeah, so let's look at an easier number. So between 0.1 and 1 Bitcoin.
Oh, okay.
Down there in the middle there.
Let's start. What if we start here? Let's start here.
Okay. Yeah.
Let's keep it simple.
There's four addresses, 4 wallets that hold 100,000 or more Bitcoin.
Okay, which
translates. It's 0% of all of the addresses out there and all of the wallets out there. But it translates to about 694,000 Bitcoin, or $35 billion, excuse me, and about 3.54% of the total worth, the total coins. Okay. So four wallets at the top hold about 3.5% of all Bitcoin out there.
Wow.
So I will acknowledge something, that the inequality distribution of Bitcoin is a lot more fairly distributed than, I would say, the wealth in the world. When you think of, the Bezos and Musks of the world, the richest people in the world, the top 1%, if you will. If you want to be in the top, let's call it top 1% of Bitcoiners, you really only need, 0.5% Bitcoin, I think. If you look over there, the percent of coins, 98.38% of all coins are owned by people that have at least 0.1 Bitcoin. So if you own 0.1 Bitcoin, you're in the top, call it 2% of Bitcoin owners.
Which is crazy. How much is that worth? How much is point?
It's about $5,000.
About $5,000. There you go.
Yeah, it doesn't take much.
$5,000, it could be yours.
I mean, to some it might be a ton, right?
Right.
But some people don't have that kind of excess savings. Some people are negative net worth out there. But it doesn't take a lot. Even just one Bitcoin is, $51,000, something like that as of this morning. So, it doesn't take a lot to get involved and have a chunk of this asset. That there's only going to be 21 million ever, right? So, what are there, 8 billion people in the world? So if it really becomes a huge part of our daily lives, then having 1 Bitcoin might not be the worst thing in the world. Fun fact, you know who one of the largest owners of Bitcoin is?
Was it anybody we showed on the beginning screen?
I'm pretty sure Musk owns a bunch, but No, I don't think any of those people are. The U.S. government, actually, is one of the largest owners of Bitcoin. They own almost 200,000 Bitcoin.
So the the currency that's supposed to overtake the U.S. currency someday, allegedly. The top one of the top owners is the U.S. government. That's actually kind of wild to think about.
Yes. So they've had 3 seizures of Bitcoin tied to exchange hacks or litigation. Silk Road was a famous one. It was a black market. They've had a couple seizures of Bitcoin from people involved in these nefarious acts. And
so they're not going out and buying Bitcoin.
They're not buying it. No,
or maybe they are.
They're not buying it. Okay. I don't think so. But they are selling it. They have periodically. They actually have auctions. They auction off the Bitcoin in chunks. So I think recently, like last month, it was like 15 Bitcoin that was approved to be auctioned off.
Interesting.
And I assume it's getting bought for fair market value. But I mean, I don't have the cash to buy 15 Bitcoin at below market, maybe below, if it's really below fair market value. But it's just interesting that they hold like $10 billion worth of, and it's nothing to the government.
Right. That's a drop in the bucket for the government.
But they're holding it. They're one of the biggest holders. I think that's fantastic.
That's very interesting.
Crazy.
Very interesting. I wonder whose job it is to decide when the government should sell. I wonder if that's someone sitting in the Fed, or if they're outside. There's like an outside counsel.
Maybe part of the Treasury. I don't know. Does that fall under like all of their seized goods? Like, is that alongside, whatever the old drugs that they seized from Al Capone and all the weapons and other stuff? Like, is there some big vault somewhere that also has the password to $10 billion worth of Bitcoin. I don't know. There's a lot with Bitcoin, and there's a lot of complexities. But let's try and break it down. Do we have the blockchain slide next? I think.
Let's see here. All right, you put it together. Oh, yep, there you go.
Yep. So I want to cover this because I think there's a lot of use cases for blockchain technology outside of Bitcoin itself. But this is a good depiction of the process here. The way I think of blockchain is it's a series of transactions. Imagine literally a chain of blocks, and each of those blocks represents some piece of data that also has a sequence to it of, the fact that there's pieces of data before it and pieces of data after it. Okay. It can be used, Walmart uses it for inventory. So if Walmart has like a salmonella or a listeria outbreak or something like that in their broccoli or their eggs or whatever it is, they use blockchain technology to track who purchased what batches from, what was the farm that it came from. They can route all this information and much more easily target the people that may be affected by these outbreaks, right? So like, let's say something was found on the farm, they can track to which stores was it distributed, on what dates, who bought it, who transacted, and then send out communication saying, look, if you bought eggs from these 3 Walmarts between these dates, there's a high likelihood that there was a avian flu at the farm at that time. You should throw out your eggs or whatever it might be.
Right.
Okay.
It makes you wonder what they did before the blockchain, right? That seems like such a complicated process. There must have been so much waste and so much time spent on that analysis.
Yeah, and like you just tell everyone to throw out their eggs if you bought them from Costco over the last month, and you can't really narrow it down as much. So there's a lot more waste. Yeah, it's very inefficient. So as it pertains to Bitcoin, each block it's about 10 minutes worth of transactions. Okay, and the cool part about blockchain is that these transaction blocks get broadcast to everyone out there who's helping to maintain the network, because everyone needs to know this is a publicly distributed ledger. So if you're a miner helping to transact these blocks, you need to know what every other miner is doing. And when there's a successful block of transactions that gets mined, everyone knows what transactions occurred, who owns what Bitcoin, and you can true up your values. And I think the really cool part is,
so everyone can see, everyone can see.
It. Yeah, you can go online. You can search Bitcoin Blockchain Explorer on Google, and you can look up, if you knew my wallet address, you could go and look it up and see every time I've ever transacted with that wallet. And the really cool aspect of this is you need consensus. So you need at least 51% of everyone mining and maintaining the blockchain to agree if there's a new block of transactions that occur. This also means that you can't edit or change anything that's already happened unless you have, like, I can't go back in time to when the first block was mined and say, oh no, actually put it in my wallet, because you would have to change everything on the chain ahead of it that's come after that point. Now, a common reason why people think Bitcoin will fail is, if there's ever a 51% majority in attack, it's called a 51% attack, you could get 51% of people to agree to falsify the data and change things and move Bitcoin into wallets where it's not supposed to be, theoretically. That's been pretty highly refuted, just given how many people are mining these days and who's out there. You'd have to convince so many people, or it would take so much compute power to do that, that no one really has the resources to compete and do that at this point. So,
right. It gains its power in numbers.
Exactly. Yep. Yeah. A lot of people are encouraged to set up their own little, node. It's called one of these, verifiers, if you will. I think it runs the same power as like an LED light bulb, but you can then contribute to the verification process and be part of the majority that says whatever's happened is true. So I think this is really important to understand, right? Did I do a good enough a job explaining how blockchain works?
This is how Bitcoin works, right? This is how we know that, so and so has X amount in their wallet, or with this wallet has X amount in. We can verify it. We know that when the payment goes from one wallet to the other, it's verified, through this process. That's what we're getting at here, right?
Yes. And whenever you buy it from anywhere, like if you buy it online, it's not just transferring it between wallets, but I say transfer, but that could be an acquisition or a sale, right? Anytime you trade it or buy it or send it somewhere, that's a transaction, and that's being logged on the blockchain in this manner. Now, the reason this is important, and we're talking about it in the context of Bitcoin, but again, I use the example with Walmart and how they're using blockchain to verify certain aspects of things. It's used a lot in supply chain management with other companies, but as it pertains to Bitcoin, it's really important because you have what's called a mining process. And the mining is the process that the computational power that goes into creating these blocks and verifying the transactions on the network. Okay. And this is very important. There is a reward that miners get for mining, for verifying these transactions. So every time a block is created, a block of new transactions, there's a reward that is unlocked and new Bitcoin is coming into the market. Okay. So this is how we got to the 19.6 or whatever million Bitcoin in circulation there are today.
And that's just like any miner, whether you're mining for gold, you're drilling for oil, right? You put all these costs and all these expenses in to get to mine the gold, and your reward is the gold, right? That you eventually find. That's exactly how a Bitcoin miner works.
Yes.
Or high level, right?
Yep. Yeah. So it started, every block is about, like I said, it takes about 10 minutes. But these computers are essentially, what they're doing is they're solving really complex algorithms. They're doing complex mathematical equations. It takes a lot of computational power. But it's basically anyone who participates, the proportional participation you have in creating these transaction blocks, you get rewarded proportionally in those Bitcoin. And for the first transaction, each block was 50 Bitcoin. So every 10 minutes, 50 Bitcoin was being spit out into the market. And after that, it's a certain amount of blocks, but it's about every 4 years, the reward gets cut in half. So there's a deflationary aspect to the new Bitcoin that's coming on the market. And we're going to go through another one of these halving processes. You'll probably hear a lot about it in the news over the next couple of months. It's going to be in like April, mid-April at some point.
Is that hard coded into the, why does it get cut in half?
Yeah, it's hard coded into the Bitcoin formula. Yeah, the source code for Bitcoin, and it's part of that 21 million. So if you go out, there's a certain amount of blocks, and you go out. Basically, at the end of the last block, it's going to be exactly 21 million Bitcoin that will have been produced and brought into circulation. I think it goes all the way out into like 2140. So we have another 120, 115 years before the last block is actually mined. And you might think, okay, well, once the reward becomes so small, it's not going to be worthwhile. It's not going to be cost effective for people to spend energy to get these slight rewards. But I think that could be one of the large reasons why Bitcoin has risen in value so much, from literally fractions of a penny to $50,000 per Bitcoin. So as the reward drops, maybe the value of that scarcity is going to continue to increase. Maybe not as parabolically as it has, but maybe there's still big gains ahead because of that reason.
Interesting. I feel like we could dive down a rabbit hole in that one. I'd be interested to know, what happens at that point. But
when they're all mined,
right? How does that change the structure? How does that change because the miners are somewhat market makers in a way.
Yeah. Well, the miners also get fees for processing the transactions. Like I said, that $1 billion transfer had a fee of $3. That's in Bitcoin. It's not like you pay someone dollars to transfer your Bitcoin. It gets taken out of the transfer that you do and that you make. So there's still going to be rewards of like that amount of Bitcoin won't change. It'll just probably become worth more money. So there's still going to be incentive to process these transactions, which by default will mean that there's more incentive to keep the network safe and true.
Right. And I think you have a picture of what one of these miners looks like, right?
Yeah. So like I said, it's solving complex algorithms. It's a lot of computational power. This is that slide there is a server farm, essentially is what it looks like. But these are literally Bitcoin miners all stacked up row by row, side by side in some warehouse somewhere.
Right. And going up, 15, 20 feet?
Yeah, it's probably, you can see the two people over there on the side. There's a forklift that gets up to the top there, and you can see all the wiring that's involved. But so these take up a lot of power. But what's interesting is they've started to partner with, like in New York State, I believe there's a nuclear power plant upstate somewhere where they've hooked up a bunch of miners. And nuclear power plants, when it's nighttime, like let's say 3 a.m, there's not a ton of load on these power plants. Like there's not a ton of demand for power at that hour, right? But the nuclear power plant is still producing the same amount of power. It's a nuclear reactor, right? So
shouldn't turn that baby off.
They don't turn it off,
yeah.
And it used to just get wasted. But now you can hook up a bunch of these Bitcoin mining computers and use the low demand power times to power your miners and make some cash. Oil flare gas, right? Like you see the old Western images of like driving through Texas and you see the oil rig going, and
sure.
Sometimes out in the ocean, you see the flare gas off the top of the pipe where it's just like burning off.
I think of North Jersey with all the, you're heading to Giant Stadium.
Yeah. So like they flare off the gas, any excess gas that they can't produce. Right. And so, that's pollutive in and of itself. And I understand using electricity can be pollutive, but what they've been able to start doing is capping and capturing that flare gas instead, and capturing the power that can generate to then run mining rigs, which can produce cash for these folks. So it's taking pollution out of the air and increasing the revenue. Quite interesting.
Very interesting.
But it takes a lot of computational power. This is a serious deal. And on the next slide, you have an image of how these subsidies have gotten chopped in half over time. So the green line here is following the left axis. So you can see the first block was mined at 50 Bitcoin per block. So every 10 minutes, 50 Bitcoin was coming into the system. And then it got cut in half after 4 years, right? Down to 25. Mm-hmm. And then after 4 years again, it got cut in half down to 12 and a half. And after 4 years in 2020, it got cut to 6 and a quarter.
Keeps stair stepping down.
Yeah. And it's going to be 3 1/8. And
so that's the halving that we're seeing. That's the halving. That's the halving.
That's the halving. And, Bitcoin has also followed these 4-year price cycles too, right? If you think about 2017 was a rally, 2021 was a rally. Before that, 2013 saw a big rally. So there's a relationship here between the boom and bust cycles of Bitcoin and when these halvings occur. And
because supply into the market needs to slow every time or it does slow every time there's a halving.
It does slow. Right. Yeah, it does. It does slow. Every time you mine a certain amount of blocks, the reward gets cut in half. It coincides with about every 4 years. But once all of a sudden you shock the market with half as much supply hitting the market,
prices need to go up. Right.
All of a sudden, let's say demand remains constant, prices are going to rise. Yeah. So part of this is, well, you say, can't you front run that if you know what's happening? Yeah, I guess you could. But this is pure supply and demand that we're talking about here. Demand right now and demand in May, I don't know, let's just call them equal. But what's going to happen in April? The reward is going to get cut in half. So all the miners are really the sell side flow here. They're the ones who they need to sell their Bitcoin and put Bitcoin into the market to upgrade their infrastructure, upgrade their chips, their mines. I mean, you saw the picture of that thing. It's very complicated, right? So as the chips become more powerful, you can and more efficient, these miners need to upgrade their technology. But
right, and this all assumes that demand at least stays the same, right? Because if for whatever reason everyone just says, you know what, I'm done with Bitcoin, right? Then it doesn't matter if it
doesn't matter what supply is. Right. Yes, of course. So, but this shows you that there will eventually be, in 2140, the 21 millionth Bitcoin will be mined at that point. I think you can do the math. What happens if you every 40 years you cut it in half until 2040? But the rewards will get tiny in terms of Bitcoin quantity. But if it's, I don't know, if it's $1 million or $10 million per Bitcoin, it still could be a lot of money.
Right.
So this is cyclical. We have it every 4 years. The reward gets chopped in half. How does this affect price? Right? Supply and demand is what basic economics would tell you is what you arrive at a price. There's an equilibrium there, right? So the next slide, there's something called the Puell multiple, okay? And basically what this looks at is the production that a miner gets for a block of Bitcoin. How is the current cost today of the block that is being mined right now? What does that reward look like in terms of value compared to the average value over the last year? So it's just a simple year over year, basically comparison of, is my reward today that I'm mining now more valuable than it was a year ago?
So wait, so for those out there sitting or standing, driving on your computers saying what the finance is going on here, let me try to reiterate that. So
please, yes.
The way I'm hearing it is, as the gold line falls, that means that miners are getting paid less, would get paid less to release Bitcoin into the market
compared to the average over the last year.
And so when it goes up, that means as a miner, you could get more money for releasing Bitcoin into the market relative to his recent. Okay.
Relative to the average over the last year. And this metric was created to try and gauge how profitable is mining right now compared to the recent past. And if I'm a miner, should I be selling my Bitcoin or should I be holding it? Right.
So when I think of this, I think of OPEC. You know, you have all the leading oil producers, the countries who they influence the price of oil by choosing when to release oil into the market, right? That additional oil into the market. So if oil isn't high enough of a price for them, they'll drill the oil. They'll still drill it, but they'll wait to release it. And while they're waiting, you know, the population keeps using the oil. And so less and less oil is left in the market, which causes prices to go up over time because the supply out there gets less while the demand either stays the same or goes higher.
Yeah.
And then once it gets to a certain level, OPEC says, you know what, this is profitable for me. This is where I could make my profit. Then they release more oil into the market, which then creates an increase in supply to meet the demand. So then price lowers naturally from that.
Yep, exactly. So if I'm a miner and let's just say the block I'm mining today is, you know, if I were to sell it, it's way less than the average I could have sold it over the last year. Maybe I'm just not going to sell it, right? And if all the miners are thinking this on the net and saying, well, we're just going to keep holding our Bitcoin, the supply in the market dwindles. And so demand staying constant, that means that price is going to rise until a point, right? And you can see every time these multiples kind of reach this red area, which is, you know, 4 to 8 times what it's been over the prior year, it coincides with, on the black line, it coincides with a relative peak, right? You saw this at the end of 2017, the end of 2013. There were 2 peaks there. Even we approached that level in 2021 when Bitcoin was kind of around its all-time highs of, 60 to 70,000. Yeah, right there.
And so that is showing the supply gets pushed into the market by the miners.
And that's the miners are saying, okay, I'm getting a really good value now. I'm going to start flooding the market with all my Bitcoin. And then because there's so much more supply and demand is whatever, let's say constant for argument's sake, the price falls from those points. Yeah. And vice versa, when it reaches the green zone on this level, this is basically around, call it 0.4 to 0.6. So saying, Bitcoin's, if I were to sell it today, I'm getting like half the value that I would have over the last year if I had sold it any other time. You see this coincides with relative bottoms in Bitcoin, around the late 2022 area, around COVID, around early 2019 and 2015.
And that's because the miners are saying, I'm not going to release any more Bitcoin into the market because I'm not going to make good profit from it. So I'm going to hold on to it. And if demand keeps increasing while supply stays the same, then the price needs to go up, right?
Theoretically, it should rise. Yeah. So basically what miners do is when times are really good, they sell probably more than they need for basic operations to have rainy day funds for when they know they're going to have to hold on to their Bitcoin. And I think it's really interesting with, we've been talking about supply and demand a lot. To me, Bitcoin is really, the demand follows the supply because the supply is what drives the price. It's not like oil in the sense that if you have a good economy, there's going to be more demand for oil because more people are driving to work and more people are building things and using construction and transporting goods and services, et cetera. If there's a recession, there's going to be less demand for oil. That has nothing to do with the price of oil or the supply of oil, right? But Bitcoin, we talked about it, there's no tangible value. So the demand is kind of steady over time or maybe slightly increasing over time as more people become familiar and knowledgeable about it. But let's just say demand is constant. Supply is dwindling over time. It's becoming less. It's a deflationary asset, right? So it's becoming more and more supply constricted over time. So all you have is the supply side of things. And that's why it's important to look at a multiple like this and look at the state of the miners when searching for price action within Bitcoin.
Right.
Now, on the demand side, you really just have sentiment. Okay. So the next chart, we look at a ratio of, this is called the MVRV ratio, but it's the market value to the realized value ratio. And it's saying, this is tracking retail flows of Bitcoin that gets sold and transacted and saying, when was the last time this Bitcoin moved? And what value was it when it moved? So think of this as like, if you're a stock investor and you have a cost basis and then you have a realized value. Okay. So we're looking at, am I selling my stock at a loss or a gain? And if it's at a gain, how big of a gain is it?
Okay. Simple enough. I like this.
Simple enough. So every time this ratio peaks is kind of at a local top in the Bitcoin price. And that makes sense because Bitcoin has gone up like, in bull markets, it goes up like 5 to 10 to 20x, not like a stock market, which goes up, maybe a double or maybe a triple. Right. It goes up a lot more. It's had much better returns in the bull markets. It's also had much worse returns in bear markets compared to the stock market. But we'll get into the return profiles in a bit. What I do want to focus on here, though, is the tops, the extremes, the tops and the bottoms more so. So capitulation would be like anyone selling at a loss, right? So if I buy a Bitcoin at $65,000 and all of a sudden it drops to 20,000, and I just say, look, I've tried this once before. I had horrible luck with it. I tried to buy Bitcoin again. I'm just going to sell it and be done with it forever. Okay, fine. Right. So every time this ratio drops below 1, you can think of someone selling their coin for less than wherever they acquired it or last transacted on it. And all of these circled areas that you just highlighted on this gold line coincide with relatively, bottom areas in Bitcoin price. all fantastic times to actually go out and buy Bitcoin. So this is more of a sentiment measure. And this really tracks, I would say it tracks more so just where the price is moving around and circulating around capitulation events, because it's based on people's behavior.
Right. And that makes a lot of sense. It's very similar to stock market, right? When you see the masses jumping ship, it's in the stock market, it's typically a sign that people are willing to sell stocks for cheap, which, for stocks, it's a great time.
I'm at a loss. I can't take any more losses. Get me into cash. I don't care. Right. And that tends to be the worst. We see this all the time, but it tends to be the worst time to sell. Right. And the same thing holds true with Bitcoin here. You can just visualize it, which is great. Right. So we talked a lot about Bitcoin. I think we covered a good amount. I want to start getting into the ETFs, because this is a very, and how do we think about Bitcoin as an investment or a part of our portfolio? And you and I have talked about this. We have some different views on this, but, for the longest time, it was really just go out and buy Bitcoin, or you can buy this thing called GBTC, the Grayscale Bitcoin Trust. And
go out and buy Bitcoin. You mean, go to the internet, go online, go to a broker, set up a wallet, go through the whole process, right? And actually there's a lot more.
It's a pain in the butt. Yeah. Or you could buy this thing called GBTC, which it was a publicly traded security. It was a trust, much like there's a gold trust. GLD is the same structure. It's a gold trust. Now, the difference with GBTC is that they did not hold, for every person that bought shares of GBTC, they didn't go out and buy Bitcoin. That's what the spot ETFs are that just came to market. Mm-hmm. GBTC just held a blanket amount of Bitcoin, and the value rose and fell based on the price of Bitcoin, but also based on the demand for Bitcoin. If more people wanted to buy it, they didn't go out and buy more. So it actually ended up trading with a premium to the net NAV, or the net asset value of the Bitcoin in that trust. And this is a chart here that illustrates that. It does go back a lot further. This premium, the scale here is not there, but it got as high as about 35, 40% in 2019, 2020. It got as low as negative 40% discount. But I will tell you, in 2017, the premium on GBTC during the peak of that bull market was like 150% on GBTC. So you were paying basically 1.5 times or 2.5 times, 2.5x, whatever you were buying in Bitcoin. You could have just gone out and bought like 2 times as much Bitcoin itself. But again, it was a lot more work than just doing it in your brokerage account.
Right. So what we're looking at here is a relative value chart. So when the line is up high above zero, that means you were paying more for that basket, right? And when it goes below zero, that represents that you were paying less than the basket was actually worth. So if you put 10
You're
Bitcoin,
for a discount,
right, in a bag, you put $100 worth of Bitcoin in a bag, right? Sometimes someone will say, you know what, I'll give you 120 for it. That's when it's at a premium. Other times when people might be like, you know what, I'll give you $90 for it. That's when it's at a discount, because either way, the bag still stays theoretically the same value. It's just what investors are willing to pay for it at that time.
Yeah, and I'm not going to get into it on this podcast, but there's there was a reason for this premium, and people were manipulating the market around this premium too. There was a carry trade where you could give them Bitcoin and they would hold it for 6 months, and then you could sell. They would give you shares back, and you could sell the shares at a premium, so you could make a profit on that for doing nothing basically. But
so this wasn't inefficient. This was not an efficient vehicle.
No, it was not efficient. It had like a 2% annual fee on it, and then it flipped to a discount for a while, and it just became a really questionable investment, but still the only way to really get exposure. The only good thing that happened in like 2021 and 22 was Coinbase went public, and Coinbase became a lot more user friendly. So, and a lot safer to hold your coins on Coinbase if you wanted to buy it there. It became a lot more popular. And I think in 2021, they had a big Super Bowl commercial, and then their website crashed, if anyone remembers that.
Yep, I remember that.
But it was a less than ideal way to get access, but it was kind of the only way you could do it in like an IRA or in a publicly traded manner. So what we can see here is all through 2023, though, this discount got erased, and it's currently at 0 as of January 26th. And this was all of that was the anticipation of Bitcoin ETFs coming to market. And we want to call this the spot Bitcoin era, right? So this means that anytime you go out and you buy shares of a Bitcoin ETF, that ETF provider is going out and buying an equal value of Bitcoin to support the value that is being held in the ETF, the value of the shares. Okay. So there are market makers that manage this. They go out, a lot of them have partnered with Coinbase. There's some big names, some small names in the ETFs. So I think it's, I see this as a positive for the market, but we'll get into this in a minute. It's also sort of it's creating this little supply crunch, the available supply, because there's clearly demand for it. There was just not enough easy ways for people to put their money into it.
Right.
So in January of this year, January 11th or 12th or something like that, a whole slew of ETFs came out. There were two that came out in like 2021, late 2021. BITO there is it's a Bitcoin strategy ETF. It's got about 2 billion in AUM in that fund, but this is a futures based contract. It's not spot. So there is some drag. We wrote about this. A while back, but when you roll those futures contracts, just like any sort of like oil ETF or the natural gas ETF, anything like that, there's a drag when you go from contract to contract.
So spot is exactly like going out and buying a stock. So if I were to go out and buy, McDonald's spot rate, so to speak, I may be making that terms up as, I don't know if that pertains to stocks, but let's pretend it does, even if it doesn't. For $296, I'm actually going and buying the shares. If I buy a future, I'm saying, that, in 3 months or whatever the time period is, if McDonald's price exceeds this amount, I'll make money on my futures contract. If it doesn't, I don't make money on the futures contract, and there's a cost to write it. So spot is actually owning the shares. Yes.
And GBTC was like completely different. GBTC has since converted into an ETF, into a spot ETF, which is great. So now they can buy and sell Bitcoin with a commensurate value of how much money they're taking in each and every day. So the interesting thing here is, because they were first to market and people have been holding their ETF for, I don't know, like 5, 6, 7 years at this point. I think it came out in like 2015, 16, something like that. You can see the AUM is so much larger than all the other ones. It has nearly 23 billion in AUM. And if you look at the flows, they've actually been losing a lot of AUM because their fee is so high. Now you can see it's got a 1.5% fee. Everything else is under 1%. There's one spot ETF that's higher. I don't even know if it's on here. I don't even think we included it. There's one at like 0.9% or 0.75% or something like that. But most of the others are around 0.25, 0.2%. There's one at 0.19%, the Franklin Templeton Bitcoin ETF. But because people have been holding GBTC for so long and Bitcoin's gone up, they're sitting with an unrealized gain. So the question kind of becomes, okay, yeah, the fee's a full percent higher than most other options out there, but are you going to realize a capital gain just to get a 1% less annual fee? I don't know.
Right. Are you going to realize a 23.8% capital gain just to save 1.5% a year?
I guess if you're going to hold Bitcoin for 20 plus years, maybe that makes sense.
Right. So GBTC is just making the bet that more people will stay in the fund, even though it's more expensive, and therefore they can charge more just because of that function.
What's 1.5% times $23 billion?
It's a big number.
They're making a lot of money. So yes, their AUM has gone down, but I don't think they really care. They're probably happy with what they're making.
Sure.
And their first mover advantage, maybe that allows them to trade with a closer spread or have a better deal with Coinbase and lower transaction costs when they get their Bitcoin. I don't know. I haven't read the fine print, but I think it's interesting. Point being, if you're going to buy one, I probably wouldn't buy that one just because it's got a higher fee now that they're all similar.
Right. Or if you're already bought in, I probably wouldn't buy more of it. I'd probably buy one of the others, while you leave, what you have in GBTC, if that's the choice you're going to make.
Yeah, you can do the math on the taxes and what the returns might be over time and what your break-even point would be. But like if you're holding it in an IRA, there's no tax consequences there. So it probably makes sense to switch to a cheaper one. But I think it's worth noting, pretty much everyone uses Coinbase as their prime broker, their trading platform when they're buying and selling the Bitcoin. So, hey, maybe that's a good thing for Coinbase stock, right? I think they just came out with earnings and it was surprise positive this last quarter. But I see a lot of people buying Coinbase stock as a way to not buy Bitcoin, but sort of the picks and shovels approach of like, all right, if everyone's going to use Coinbase to transact, maybe I'll just buy shares in that. And whether the price goes up or down doesn't really matter to me, but I'm going to make money transacting over time.
Which is interesting too, because as Bitcoin becomes more popular, technically Coinbase's margins should shrink. So Coinbase should theoretically get less profitable, from a margin standpoint, as Bitcoin grows bigger and bigger and bigger. So it's almost, the ETF is almost helping and hurting at the same time.
Which they have. It used to be like $100 just to place a Bitcoin trade.
Which is absolutely nuts.
But you saw the same thing with stock trading. That's the crazy, like people forget this, but stocks used to trade in the 90s in eighths of a dollar, like eighths of a dollar, 12.5 cents. So they didn't even have pennies. That was decimalization. So, and it used to cost like $25, $50 to place a trade. And trading's gone away and you have decimalization. So the spreads have gotten tighter. So, things have become more efficient on the stock side. Same thing with cryptocurrency. Actually, I don't like to call it cryptocurrency, but digital assets, same thing. It used to be like $100 just to trade minimum, or they would charge you 2% if your trade was big enough. Now it's come way, way down. And like you said, the margins are shrinking. So,
I mean, look at stock trades now. Most stock trades are $0. Right. What happens to Coinbase's business model when it gets to that point? I don't know. Maybe they.
If anyone's listening and you're still paying trading commissions, please call me after this. You shouldn't be. PSA. And so I think the point here is some of these, the AUM numbers are what I'm looking at. I don't a quarter of a percent versus 0.2%. ARK tried to get creative and did 0.21 for the 21 million Bitcoin. So that's, one decimal point. Look, you're splitting hairs over the fee, but take a look at the AUM. And if you're going to pick one of these things to invest in, you could bet on your horse now, or you could wait a couple months and see, who's going to be around for a while, because there are costs associated with maintaining these ETFs. And if they're not going to be picking up funds, then I don't know that, you run the risk they're just going to liquidate, give you your fair market value back and close up shop.
Right. So, and AUM, or assets under management, is important because that generally means there's more people transacting it. So when you go out and buy it, right, you're going to get closer to fair market value. Yep. Usually when there's less of an AUM, a lower AUM, especially when you're not around that $1 billion or more, you're going to be looking at a bigger and bigger haircut on, when you transact it versus what fair market value is at the time. And then it also could be tougher to get out of a fund, an ETF, when there's a sell-off or a major run on the Bitcoin or the fund itself, because there's going to be less people transacting in those smaller funds. So you generally want to go for a bigger fund. Over $1 billion, you start splitting hairs, but you generally want to go to, a bigger fund, just so that, you don't have to take as big of a haircut on transactions. And then also, should there be a run on the position, it is more likely that you'll be able to get out of it closer to fair market value than having to take a deeper haircut.
That's a good point. I mean, look, they're all supposed to trade at fair market value. That's what market makers are. That's like part of the structure of markets. But the more AUM, probably the better if you have a choice. I think the tickers are kind of fun too. iShares is iBit, that makes sense. Fidelity, Bitcoin, FBTC. You have ARK is Kathy Wood's company, so ARK B.
Right.
And then I like a HODL.
I love HODL.
So HODL is, what do you think it stands for? Do you know what it stands for?
I know what it stands for.
Okay. So hold on for dear life, right? But
which is funny because, right, that's what you're doing as a Bitcoin investor to some extent.
Yeah, you kind of like, it's so volatile that you want to, like, we'll see in a minute, but the price drawdowns are like 80 to 90% in bear markets. It's wild swings. And there was back in the days of like old chat forums in 2013 or 14 or something like that, during that bear market, someone kept saying hold, but they were made a typo and it came out HODL. And so hold on for dear life was an acronym that actually came after the fact. It was meant to be hold, like saying don't sell, hold your Bitcoin. But there was a typo that then derived the acronym of hold on for dear life. Yeah.
Some clever internet troll took it and turned it into something. That's great.
For dear life.
That's great.
Power of the internet. I like Burr too, the BRRR. That's the Valkyrie one. That's a reference to Jerome Powell and the money printer. The money printer goes Burr with him moving this crank to print out all the money. But anyways, and then DeFi is decentralized finance. That's the Hashdex Bitcoin futures ETF. So some creative tickers. I'll give everyone a couple of people.
They all hired good marketing companies.
Yeah, exactly. Not that matters, but this was pretty historic landslide moment. They are talking about doing the same thing with Ethereum ETFs, which is another sort of the second largest digital asset out there. Ethereum, we can get into this maybe some other time, but not a constrained supply. So there's unlimited supply, and therefore the value has a lot more use cases. So things like NFTs came from Ethereum. It's a separate blockchain, the Ethereum blockchain. So, who knows if holding Ethereum in this way is going to function the same way as like digital gold, but or Bitcoin would. But those could be coming down the pipe as well, just so people are aware.
I mean, this was huge in that I don't think we've ever had 10 ETFs all come out at once. I don't think that's ever happened for the same asset class, right? I don't think it's ever happened. I don't even think
the SEC
5
had to do it this way. If they had given approval to some and not others, it would have been such a nightmare for anyone else trying to come in. So they said, let's just release them all at once. Anyone who had applied got approved, basically. Some people, I think there was 1 or 2 people that backed out of it because they realized they weren't going to be able to win in a horse race against BlackRock and Fidelity from an asset perspective. So I think it's fair the way they did it, but it flooded the market with potential opportunities. So It's probably good for the consumer at the end of the day.
Right.
As long as you choose the right one, I guess.
It's true. So let's keep moving through here.
Yeah. So the next slide just talks, I think since it came out on the 11th, we kind of want to know, okay, well, what have the flows been like? This shows each of these colors.
11th of January. Okay.
It's not meant to matter who's getting what flows necessarily, but these are daily flows. Okay. Through last week on the net of Bitcoin coming into the market. And you can see the black at the bottom is the outflows from GBTC. Those have largely subsided. I think anyone who's gotten out of GBTC has done so at this point. And they've gone into some other Bitcoin product or Bitcoin ETF. But most of these days, the net flows were positive, and they're really positive.
Right.
I mean, like you're talking, what is that? 477 million. These are millions of dollars, I believe. So it's a lot going in.
Yeah. You could see how the line this dark line dips in the beginning. That may have been, if I had to guess, the the arbitrageurs who got into GBTC just to play that discount that was in it prior to the ETFs coming out. That's probably them coming out. Maybe some people who held regular Bitcoin, selling, who was also doing a similar type of, or hoping at least that there'd be an upswing when the ETF came out. But then after that, they're cruising.
You can do the math here, right? So there's about 900 Bitcoin coming online today per day through the mining. So 900 times 50,000, let's just say that's about $45 million worth of Bitcoin coming into the market. And that's about to get cut in half. Okay. So, this is, I think it's 500 Bitcoin, but I'll double check here. The 500 Bitcoin, let's say, being gobbled up by these ETFs per day is being held, right? So if the supply from miners is going to go from 900 per day down to 450 per day, you're going to have, if these flows hold steady at these levels or even get chopped in half, you're just talking about huge supply getting taken off the market. And that's where you have a supply crunch potentially coming with the halving coming up. And again, that's what sets off these sort of, or in the past has tended to set off these big moves in Bitcoin.
Right. So if you're thinking about jumping into Bitcoin, what can you expect in terms of return pattern?
I would expect a lot of booms and a lot of busts, right? This is a great chart here. It shows the drawdowns essentially from the all-time highs. So these pink bars that go down is over on the left scale. So you can see, every bear market that Bitcoin has had has coincided with at least a 75% drawdown from the all-time high. So if you're the type of person that doesn't like volatility in your stock portfolio or in your general life, I just wouldn't buy it. You're probably going to get sick to your stomach and not be able to look at it, and you're going to sell it at the wrong time. Chances are.
I think that's huge. I mean, this is a great visual here.
We look at, on our economic presentation, we look at this from a stock perspective, and every year you tend to see like 5 to 10% drawdowns in the market. So if you get nervous, like if you got nervous in September and October when we had a 10% market correction, just don't buy Bitcoin.
Right.
You don't need it. If and when the day comes that we feel it's good for clients, we'll put it into their portfolios.
Right. That's where I was going with this. I mean, we find that certain clients have enough difficulty staying in the stock market when it drops 15% or 30 or 40%, right? And at least with the stock market, you have this assurance that you're holding actual companies that have earnings power and pay dividends, right? Its value rests in the value that each individual company you own can generate over a period of time. And, many people have trouble staying disciplined during those sell-off periods with stocks. But with like a Bitcoin, right? If Bitcoin falls 40, 50%, what are you hanging your hat on? Bitcoin in itself,
not earnings.
in itself does not, right. It's not creating its own value. It's not creating its own value in terms of earnings or dividends. The value is created because supply is controlled and there's enough people out there who think the next person's going to be willing to eventually pay more in it, right? So I think investors really need to sit down and think long and hard and say, can I actually stay disciplined? And if you can't stay disciplined with the stock market, you're probably not staying disciplined with Bitcoin, because Bitcoin's going to be a bad investment if you buy it and then it drops and you panic sell. Like, you're not making money.
No, you just go to the casino or something. I mean,
right.
you probably have better odds playing blackjack than doing that if you're going to get swayed by the emotional aspect of this. Look, since 2010, Bitcoin has been the best performing asset class. Nothing has beaten it. I don't know that that's going to be the case for the next 14 years. I don't think anyone could confidently say that. Stocks could beat Bitcoin. Bitcoin could go to zero. There's a number of things that could happen where, there's a reason it's not in our client portfolios right now, because we don't feel comfortable putting it in there at this point in time. So I don't know if that changes in the future. But these drawdowns are just amazing. And I will say too, this is a log scale chart. So on the right, you can see the scale is logarithmic because of how drastic the increase has been.
Right.
If that's why it doesn't look like a 70% drawdown, in 2019, it's because it's a logarithmic scale. But, prices went from 20,000 to 3,000 in 2019, from late 2017 to 2019. Just recently in 22, they went from about 70,000 to about 16,000. So that was a 78% drop or so. And now we're back up at 50,000 and no one's really talking about it like they were in the peak. So I think it's really interesting. And I think the returns going forward are going to be more muted, even if they're positive, than they had been in the initial days. But just like stocks, I would say that return is asymmetric, right? The most you can lose when you buy a Bitcoin is $50,000.
The value you paid.
The value you paid. Mm-hmm. Right. Same thing with Apple stock. If you go out and buy Apple stock today for $190 a share, the most you can lose is $190 a share. It goes to zero. Right. The most you can gain with Apple stock is an infinity amount. Right. So
exactly.
I think the same kind of holds true with Bitcoin, in that sense, versus like a bond. I don't think bonds do not have asymmetric returns. Their returns are predetermined based on your purchase price and where they're going to mature. Bonds could also go to zero. So you can't have that infinity return possibility with buying a bond. Right. So when you think about a risk spectrum, stocks tend to be all the way on one end and cash is sort of all the way on the other. I would maybe extend it for Bitcoin. Extend it out more. Yeah. Look, I think it's interesting. You might see more correlation with stocks and maybe more of a break from this 4-year cycle in the future. So I'm really curious to see where this goes. I hope this conversation, though, was helpful in understanding it. We wanted to talk about the ETFs. Not that we have a preferred one to buy or anything like that, but I know some clients have asked about it, and it was a pretty milestone event. So I also think Bitcoin will start to be in the news more as we approach that halving event, which will happen sometime in mid-April. So we wanted to do this episode and hopefully educate some people along the way.
Right. A deep dive to give you a roundabout experience of Bitcoin without getting too technical and losing.
We definitely got pretty technical. So apologies in advance. If you want to talk more about it, you can ask your financial advisor about it or give me a call. That's fine. I always like brainiacking out and geeking out about this stuff. So
yeah. And if you liked this presentation, if you found it helpful, if you liked this podcast, found it helpful, please share it. Don't keep us a secret. No need to keep us a secret here. So please share, please like it we're on all of the major platforms, whether you're, talking about YouTube or any of the podcast platforms. So please follow, like, and all the above.
Can we get that awesome, just in closing, as we talk about, some new shows and movies and books and stuff that we've been reading. Can we get that image that Nick put together, the AI image? As our background.
There you go.
This is so great.
It's so
Nick,
great. Yeah.
Nick, we got to do more of this. Anyways, what are you into lately? What have you been watching?
So
I know you talked about Masters of the Air last time, and I've since caught up with that, and it's awesome. So I would second that.
Love it. Love Masters of the Air. It's the 100th Bombardment Group. World War II, we're talking about the Fortress heavy bomber. So you have, 4 or 5 people on a plane. So you're caught up.
I'm all caught up.
Is the Elvis guy dead? I think he might not be dead. I think they might be just kind of playing the slow game.
Please, no spoilers here for those that haven't seen it. But I forget his name, but it's the actor that played Elvis in the recent Elvis movie. It's really good. It's produced by the same team that did Band of Brothers,
right,
and The Pacific, and it's on HBO as well, or Max as they call it now, and it's part of that series documentary.
Yeah, it's fantastic. It gives you a realistic insight into what they went through, which someone who is a student of history, it still surprised me. Actually seeing it The production value is fantastic. So definitely, if you haven't watched Massive Bears, watch Band of Brothers, watch The Pacific. They're great shows.
Band of Brothers came out, over 20 years ago now at this point?
Yeah, I think the
2001.
Pacific came out, I think, in 2010-ish, maybe.
Okay.
So,
yeah, Band of Brothers, 2001. So, yeah. They've come a long way with their production quality, but it's very good. That was good. I also watched True Detective, which is good. I would recommend that. The first season was awesome with Matthew.
Yeah, I've seen that one. That was great.
And Woody Harrelson, but I wouldn't. No need to watch season 2 or 3. They are standalone seasons, but the fourth one is really good. It takes place way up in northern Alaska in around Christmas and New Year's time when they're in a constant state of nighttime. So it's very eerie and interesting.
So I haven't seen it, but I hear things start to get weird.
Yeah. It's a murder mystery, but there's always something a little not supernatural. I don't know if that's the word, but like there's always something that's very unusual about the murder cases throughout the True Detective series. So if you haven't seen season 1, go back and watch that with Matthew McConaughey and Woody Harrelson. That was fantastic. And then season 4 is also, as standalone, very good as well. Jodie Foster's in it.
There you go. So we got good Bitcoin content and good TV show content. So, very good. Well, we appreciate everybody tuning in. So, thank you very much.
All right. Thanks, everyone.